Good morning, everyone. I'd like to welcome those joining us remotely and in person to the Investment Advisory meeting of the State Treasurer's Office. I'd like the State Treasurer officially call the meeting to order. If you'll stand and join us for our Pledge of Allegiance and then our salute to the North Carolina flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the old North State love, loyalty, and faith. In that regard, we will, without objection, we'll adjourn our meeting today in honor of Veterans Day. Thank all of those who have given the sacrifice to serve. It's a verb, to serve. And a lot of places around the state are doing these green light proclamations. We should have bought futures in green light bulbs because people are putting green lights in their porch lamps in honor of Veterans Week. So I think you'll see more of that next year as it gets going. I'll ask Ben Garner to call the roll to determine the quorum.
Good morning, Ben Garner here, General Counsel for the Department of State Treasurer. First, Mr. John Anarella.
Here.
Mr. Brewer.
Here, good morning.
Good morning. Mr. Coakley. Mr. Mevin.
Here.
Morning. Mr. Patterson. And Treasurer Forward.
Okay, thank you. I appreciate board members being flexible to change this date. Is that what it is?
Yeah.
From
Next Wednesday, 16th.
I'm sorry I couldn't be here next Wednesday, and I appreciate the flexibility of the board to come together and create a quorum. Committee members, thank you. Here's some quick reminders regarding housekeeping. Please mute your phone when you're not speaking. There will not be any motions in this meeting, but if someone were to say something, please identify yourself for the meeting minutes. If you decide to leave the meeting for any purpose, please notify us so that we can record that for the record and also notify us when you come back in. We're posted this meeting for public availability on our website. If we, for some reason, lose our phone connection, the meeting will be deemed to be in recess, and we'll put a notice on the Treasurer's homepage and information about when the meeting can resume. Any questions among those that are joining us in person or by phone regarding these procedures? Hearing none, I'd ask for a motion to approve the meeting minutes of the third quarter IHC meeting of August 24th. Without objection, for efficiency purposes, any motion or second to a motion will be considered a yes vote for roll call.
Greg Patterson, so moved.
Motion by Mr. Patterson. Second by Mr. Anarella. Any further discussion? Hearing none, clerk will call the roll.
Mr. Brewer.
Aye.
Mr. Mevin.
No.
Aye. Okay, thank you, members. We'll now go right into our agenda and hear a performance update from our co-CEOs, Christopher Morris and Jeff Smith.
Morning. Glad everybody with us this morning, either in person or by phone. So really, when we look back at the third quarter, really three key themes, I guess, that come across there: persistent inflation, a hawkish Fed, and growing geopolitical risk. We had central banks clearly signaling the commitment to fighting inflation, with the Fed, the ECB, the BOE all raising rates during the quarter. Tight labor markets, unemployment near lows, and the low labor force participation resulted in pressure and increased wage growth. As we started the quarter in July, the CPI reading showed some moderation in the inflation data, and off of that moderation, we saw equity markets in July rally as there was some speculation that maybe the Fed would quote pivot, and that interest rate cuts in 2023 could be on the table due to slowing growth. But we got comment later in the quarter, particularly at Jackson Hole in August, really threw cold water on that idea of a pivot and signaled no stop to raising rates and fighting inflation, and that really sent stocks lower, pressured things the rest of the quarter. The Fed then raised rates 75 basis points again in September, signaled they would continue again raising. Overall, we saw domestic markets though outpace international as the geopolitical risk weighed really heavily on the foreign developed markets, a little more than domestically. We'll talk some more about fixed income as we have that on the agenda in detail here coming up. But as a whole, what we saw in the quarter was the curve moving higher. 5-year was up over 100 basis points. 10-year was up over 80, 30-year up around 60. And we've actually seen that pressure continue a little bit quarter to date since that end. On the commodity side, negative returns across on the GSCI commodities index as a whole, particularly weaker prices for crude oil and metals. That was kind of the backdrop for the quarter.
Thank you.
Thanks, Jeff. Good morning, everybody. Turning to the portfolio, looking at slide 7 here, total assets under management for the investments division as of the end of Q3 was about 161.6 billion, which was down about 5.4 billion for the quarter. The decrease there was due mainly to the depreciation of NCRS, which decreased about 5.2 billion as all markets were under pressure for the quarter. See more about that going forward. Moving on to slide 8, looking at our asset allocation. As of September 30th, you can see that the portfolio was valued at 105.7 billion, down from about 111 billion at the end of June. From a portfolio positioning standpoint, there were no major changes to the portfolio, although we were slightly more underweight equities with the sell-off in the quarter. The growth underweight is at 8.7%, with the majority of that coming from public equity. We continue to be overweight rates and liquidity at about 7.55%, with the cash portfolio comprising all of that overweight. Fixed income is slightly below the target by about 1%. The inflation sensitive and diversifiers portfolio was right at target, just slightly over. The allocation to this segment has increased this year, in part just due to the fact that this portfolio has performed very well compared to the other portfolios. Both the inflation sensitive portfolio as well as core real estate has performed pretty well for the year, and led to an increase in allocation. Multi-strategy is at 2%, which is 1% over target. But as you recall from our last meeting, we just shifted that target weight with our new investment policy statement down from 2% to 1%. So we haven't made any significant changes there. Flipping to slide 9, the more recent snapshot of our asset allocation. So this is preliminarily our end of October numbers. You can see assets increased pretty significantly. We were just under 107 billion at the end of October. Markets rebounded pretty significantly in October, leading to that increase. No major changes in allocation since quarter end, although that underweight to equities and to growth have decreased as markets rallied. Turning to slide 10 and our portfolio returns versus our benchmarks, you can see that the portfolio was continued to have its challenges in Q3, down about 4.2% for the quarter as both equity and bond markets continued to struggle, with equities down about 7% for the quarter and IG fixed income down about 5% for the quarter. The alternative asset classes continued to outperform the public markets, but almost all asset classes struggled in Q3. The 1-year return at the end of September was negative 11.6%, again driven by the negative pressures we saw in both public equities and fixed income markets. With the pullback this quarter, the portfolio has only exceeded the actuarial rate of return of 6.5% for the 20-year number, as you can see on this chart. On a positive note, relative performance versus both our benchmarks has continued to be very strong. For the quarter, the portfolio significantly outperformed both the implementation benchmark and the long-term policy benchmark, as you can see here.
Go back to what you just said about 2020. It's the only period.
Yeah, at the end of September, it's the only period that's above the 6.5% actuarial
Oh,
rate
I'm
of
sorry.
return.
I thought you said the only period where we've seen the benchmark.
Okay,
Not the bench,
The actuarial assumed rate of return.
Yes,
I'm sorry.
the actuarial assumed
Let's
rate of return.
clarify that, okay.
Yeah, that's at 6.59% at the end of, so yeah, this drawdown this year has obviously put a lot of pressure on those longer term time periods as well.
But the performance of the plan versus the benchmark, that's a different topic.
Yes, yeah. So so we have our two main benchmarks, right? Our implementation benchmark and a long-term policy benchmark. And versus both of those across the board, you can see that the portfolio has performed extremely well. The short-term outperformance has been driven by both the positioning of the portfolio, the underweight to equities, overweight to cash, as well as strong relative performance of some of the asset classes, specifically IG fixed income has outperformed significantly during this downturn. We'll see some of the attribution charts a little later on. For the 1 year time period, the fund outperformed the implementation benchmark by 1.2%, which is pretty significant outperformance at the total plan level. But it outperformed the long-term policy benchmark by 6%, which is very significant given, as you recall, that the long-term policy benchmark is really a passive implementation that tries to mirror what our risk profile is. It's really just all public markets. So it's a lot of it's public equities, global public equities, as well as there's a big chunk of 5-year plus treasuries on there as well, which has obviously been challenged as well. So we've significantly outperformed that long-term benchmark for the 1 year period. And as I mentioned before, for all time periods shown here, which is our standard time periods, the portfolio has outperformed both the implementation benchmark and the long-term policy benchmark. So we're certainly happy to see that, despite the fact that the absolute returns have been quite negative this year. Taking a look at Q4, so equity markets rallied in October, as I mentioned earlier, and continue to see a lot of volatility as we head into November. November is roughly flat through yesterday. The portfolio as a whole is up north of 1% quarter to date, but is still down more than 12% calendar year to date. So we're on pace to have our worst absolute return since the financial crisis in 2008. So this has certainly been an extremely challenging year, and I think we're trying to manage through it the best we can. Obviously, the relative returns show that we've done a pretty good job of outperforming our benchmarks, but yeah, it's certainly been a pretty painful year to sit through. Moving on to the next slide, growth of a dollar. Again, we show this every time, shows the total pension plan in orange there, and then the two benchmarks. Over the long term, we have exceeded both of those from this perspective as well, although you can see certainly the large downturn in the value of the assets this year. Next slide shows the same chart, one with for the 5 years time period and one for the 10-year time period. And we also put in our alternatives asset class in the green line there. So this really kind of shows how our alternatives have either hurt or helped or hurt us over these time periods. And you can see the green line is higher than both the pension plan or the implementation benchmark line item, or I guess that's the long-term policy benchmark in yellow there. So these alternative asset classes have continued to be positive from a diversification standpoint, from a valuation standpoint, and has certainly helped the portfolio, especially during time periods like we're seeing now, where both equities and fixed income have struggled. Slide 13 shows our contribution to total plan return for the 1 year time period. So this shows in both percentages and then earnings. So you can see on the top right there, it shows the total pension return of negative 11.6%, which I mentioned earlier. That equates to an approximate loss in earnings of about 13.2 billion, which you can see on that top left. And you can see how each asset class has contributed to that return and that the loss of earnings there. So no surprise, the public equity and the IG fixed income have had the most challenges this year and has really driven the negative returns that we have seen. Alternatives as a whole has been added. As you can see on the right there, the total alternatives has added 1.37% to the portfolio, and then cash has been an addition as well, with rates being low to begin the year, but the fact that it wasn't in IG fixed or public equity where we certainly had some losses, it was a benefit to the portfolio. You'll see that here as well in the next slide. So this is the attribution, which compares the portfolio versus the implementation benchmark and kind of breaks that down into why we outperform by the 1.2%. You can see on the top right, it breaks it down between selection effect and allocation effect. And I talk about this every time, but allocation effect is how we're positioned, how each asset class is positioned versus our portfolio and versus our policy targets. And the selection effect is how each asset class. No, the selection effect is how each asset class return. Yeah. The selection effect is how each asset class performed versus their individual benchmarks. So you can see here for the 1 year time period, and this was a little different than what we had seen in the past, the allocation effect is what solely drove the outperformance of the portfolio. So the overweight to cash, which you can see in the bottom left there are active weights for our average active weights for this time period. The 10% overweight to cash, the 6.7% underweight to public equity had a significant benefit to the plan versus our benchmark for this 1 year time period. And you can see how much in the allocation effect chart in the middle there. So those two added about 1.9% versus the benchmark just by being overweight cash and underweight public equity. So we talked about how that had been challenging, and it certainly didn't help us in 2021 as a whole. But this year, given the struggles that the public markets have had, it has been a significant addition versus our benchmarks. Again, looking at the 3 year time period, slightly different story here. The portfolio slightly outperformed the benchmark by 0.06%, so 6 basis points we outperformed, and that was driven solely by, or not solely, but driven mainly by selection effect. And you can see that the allocation effect was negative for that 3 year time period. Similar story for the 5 year on the next slide. Portfolio outperformed pretty significantly by about 35 basis points to the 5 year time period. And that was driven mainly by selection effect. And what we like to see here is on the selection effect on the bottom right there, you can see that each asset class added value versus for the plan versus the benchmark. So every asset class has done a very good job versus their individual benchmark. So we're certainly happy to see that. We're certainly proud to see that each asset class has done really well for the longer time period. Moving on to slide 17. Show this chart. This chart shows several different risk metrics. I'm just going to focus on kind of the top left there. You can see the rolling volatility of the portfolio for the different time periods. The blue line is the 1 year moving average. The orange is the 3 year, and the gray line is the 5 year. You can see on the 1 year, you can really see how that's bounced around pretty significantly. The last 3-4 years, you had some periods of low volatility, other periods of high volatility. And you can see that it's really spiked significantly this year as well as volatility ticked up quite a bit. But I think it's also interesting is the longer term trends, where if you look at the 3 and the 5 year numbers, you can see how that volatility of the portfolio decreased significantly from the post 2011 time period all the way until it bottomed out around 2018 or so at about 4%. So our long term volatility was around 4%. Which was an all-time low. And I think folks that were here, most of the members of the ISC were here at that time. We talked about the really low volatility environment. Well, we've seen the opposite of that the last 3 or 4 years, right? And you can see how that number, even the longer term numbers, the 3 and the 5 year numbers, really trended up significantly over the last 4 or 5 years. And as I said, those bottomed out at around 4%. Now you can see that the 3 year moving average is over 8%, and the 5 year moving average is over 7%. So we've significantly seen kind of the longer term trends. Again, we've obviously had some pretty significant events take place over the last few years, which led to some of that volatility. But I wouldn't anticipate the volatility remaining high for an extended period of time. But it's certainly something that we've seen throughout the last 3 or 4 years, which is pretty similar to kind of what we saw during the financial crisis in 2008 and all the way through 2011. We saw this very large period of high volatility. We're kind of seeing that again, and obviously I think it's for different reasons, but it's pretty interesting, and it can lead to more opportunities, but it obviously makes it kind of a little bit more difficult to manage through this. Moving on to the next slide, slide 18. We show this slide as well. It kind of shows our drawdown capture and kind of our downside protection that we have in the plan. And you can see on the far right on the bottom chart there that how significant of a drop off we have seen this year from all-time highs right at the end of 2021. But we do continue to see kind of the portfolio showing good characteristics of good downside capture, right? Or drawdown protection, where, you know, the green line is the S&P 500. That's down more than 20%, or it was through the end of September. And our portfolio wasn't down near as much as that. So we continue to see that. Again, it's been a little bit different environment with our normal fixed income. That's usually the anchor to the portfolio, struggling as much as it has. But the diversification of the rest of the plan, I think, helps. And, you know, we continue to see pretty strong downside protection in these markets. So the universe comparison, this is where we show our returns and risk profile compared to some of our public peers, mainly the BNY Mellon universe of public funds greater than 20 billion. You know, we talk about historically how in falling markets and bear markets, we typically perform pretty well given our conservative profile. You know, looking at these numbers, it doesn't look so much. I've seen that, especially if you look at the 1 year number where we're in the 63rd percentile, which certainly is below the peer median. And for the 3 year and the 5 year, we're even farther down the percentile rank as that. What I did run, and which we don't show on these charts, is I took a look at the calendar year to date comparison, given that's really where all the drawdown has been. It's been all in 2022. And it shows more of what we would expect. We're in the 38th percentile versus our peers for the calendar year to date. So we are in the top half, and we are, you know, closer to that top quartile, which we would expect to be given where the markets have been. Slide 20 shows the Sharpe ratio. Again, this is kind of a combination of the return and the risk. Shorter time periods has been a challenge, just given where the markets have been. Longer time periods, we continue to see these numbers being very strong for this plan. You know, in the top half at least for anything greater than the 10-year time period. I'll shift now to the liquidity profile slide. Nothing changed dramatically here. This is where we show how liquid our portfolio is, with the blue bars being the most liquid and the yellow bars being the least liquid. We try to maintain a policy minimum of 70% of the portfolio in what we call level 1 liquidity, which is the most liquid assets. And we're currently at about 73% there. So we are above kind of our monitoring threshold there. So, but no big changes from the previous quarter. The next slide shows benefit payments by calendar year. We've talked about this a little bit recently. We've seen the total net benefit payments out of the portfolio. So this is net what comes out of the investment portfolio. This is not gross benefit payments. Gross benefit payments continue to increase year over year. The net benefit payments is net of contributions. So net what the employee puts in, net what the employer puts in. And then they ask us for the difference to fund from the investment portfolio. So we had seen this trending down over the last couple of years due to really some of the funding policy that the boards have set for the retirement systems as a whole. We would expect this to bottom out pretty soon, and we may have seen that this year, although there was a bit of a anomaly this year where you can see it kind of looks like it's ticking up for 2022, but we did have to pay out the supplemental one-time COLA that was issued by the General Assembly. We did have to pay that out in October, so it did show a bit of a spike there. That will be reimbursed over time as those payments come in from the employers.
So let's, so the gray is specific to the supplement.
No, the gray is just the projected. So we try to project for the year.
Okay.
So the blue is actual through October, and then the gray just projects what November and December would be.
And that's a one-time supplement.
Yes.
And that includes the teasers and the elders.
Yes.
And to be clear, the General Assembly wanted us to pay this out on one day, but they didn't give us the money that day.
That is my understanding, yes.
All right.
Yeah, we paid that out. It got paid out in, I think, the October payments. So it all got paid out at one time, but it gets reimbursed, I guess, throughout the years, is my understanding. Moving on to slide 23. And this is the alternatives liquidity profile for these asset classes.
Back up just a minute.
Yep.
Would you have predicted 3 years ago that that blue line would have that trend that it does? With people living longer, retiring earlier? I mean, I get a little stunned by this graph.
Yeah, and we've looked
I
into
would
this.
think it would be moving the other direction intuitively.
Yeah, I mean, again, this is net what comes out of the investment portfolio, right? So those gross payments are increasing. The actual payments to the beneficiaries is increasing. It's due to the
Say that a little slower.
sorry,
Gross benefits are.
gross benefit payments are increasing
Right.
year over year, right? What we show here is what comes out of the investment portfolio on a monthly basis. We basically get a request to fund what's needed month to month to pay the beneficiaries, right? Because you have contributions coming in from the employee and the employers. We have to fund the difference out of the investment portfolio. So this is the net funds that are coming out of the investment portfolio. So the gross payments are increasing. They're going to continue to increase. I would expect that this will turn and increase. It will at some point. The reason it's been going down, and we've looked into this because we had this similar question, is really the aggressive funding policy that the boards have taken. Teasers and Elgers have been very aggressive at, I guess, pre-funding through this ECRIS policy that they have. And by doing so, it puts less pressure on the investment portfolio and funding to come from the investment portfolio. So long term, it's a great thing, right? If you pre-fund this, less money's needed out of the investment portfolio, more money that we can earn in the investment portfolio over the long term.
And to be clear with our members, I think we're going to top 7 billion this year in gross benefit payments. 7 billion for the first time in our history, and over a period of time, that's going to go to 10 billion a year. So.
Moving to slide 23. So this shows kind of net cash flows from each alternative asset class and our alternatives as a whole. I guess the main point here, if you look at the top right there, that black diamond there is the net amount that we've gotten over the past 12 months. So we are cash flow positive. We continue to be cash flow positive, which means we're getting more money returned to us from these asset classes than we're paying into them. And we've been cash flow positive by about 3.1 billion for the previous 12 months. Pretty similar story that we've had in the recent several years. We've had some extremely strong returns in some of these asset classes, and we've realized some significant gains in some of them as well. And so they return the capital to us, which is good to see. You know, we have seen a slowdown in transactions as a whole, I would say, this year, given the volatility in the markets. But we've seen a decrease in both kind of contributions out to the managers and distribution. So the net has really been pretty consistent over time. So we continue to see that, and we're likely to see that positive cash flow in the future. And then the last slide I'll hit here is one I show every time. It doesn't change dramatically from quarter to quarter. This just shows how the portfolio is valued. Some of our assets are valued daily, some of them are valued monthly, some are valued quarterly on a lag. And this really shows the percentage of that. So you can see kind of the majority of the portfolio in the blue there, in the bottom chart is daily valued, about 72.5%. The orange and the gray are the monthly valued. It's about 8% or so, a little more than that. And then you can see around 19% of the portfolio is quarterly valued. Most of that's on a 3-month lag. So a lot of those asset classes, private equity, some of the real estate, and you can see by asset class up on the top there, are quarterly valued on a 3-month lag. So the September 30 valuation here is using June 30 marks. So that just kind of shows you there is a lag in some of those asset classes, which can lead to some confusion when equity markets are down significantly. You would expect maybe private markets to follow, and they typically do to some extent, but it's usually a quarter later in how we value it. There's no questions there. I'll turn it back over to Jeff.
Any questions among Greg or anybody joining us by phone?
Here.
Proceed.
We'll turn to slide 25 here. Kind of building on what Chris was saying there about the timing issue that you see sometimes on it. I think if you look at, the private public equity, a lot of that gets washed out when we look at the longer time frames. And so on this chart, as I'm looking at the two of those, private versus public, over the long time periods, I think we really see the value of the private equity piece there relative to public that sticks out. Now turning back to the 1 year, a lot of these things we've really hit on already, but obviously really ugly time for our public markets, public equity. On the 1 year down 24, IG fixed down 14. And on the positive side, in this high inflation environment, I think it's since we really set up the inflation portfolio years ago, the first real time that we've seen a material spike in that. So you really want to look and see, okay, what does that really do what it's supposed to do at the end of the day? And I think when we look at those numbers and see inside of that inflation, the inflation sensitive at, over 9%, core real estate, pushing 10%, makes you feel good about how that's structured and set up relative to the environment that we've been in. And then on the positive return side, non-core also really on the growth side, so had a really good 1 year periods. Flipping to slide 26, again, a lot of themes. Really, the data here on the far right, year to date, is pretty close to the same time frame we just looked at, so nothing materially different there. I think maybe reflecting back on that, Chris was talking about earlier, see about how we do versus the policy benchmark. Just really, if you had just a public market implementation and no privates, and you really look at the bottom quarter of that chart in the corner there, and there's your two public markets at the bottom year to date, and IG fixed and public equity. So everything up there above it is the things we're talking about that we do in the private markets inside of public. So the real driving reason why we look better than what a policy benchmark would be on it is really how strong those asset classes have been and how poor things have gone in public markets. So moving on to slide 27, our new and incremental and unfunded investments. Only a couple of new items on here. Public equity, another $200 million into our internal U.S. core in October there. And then as well, one new vehicle there in non-core real estate with private storage of 300. On the right side, on our unfunded number there, you can see we're still at 6.9 billion there. When we sat down last quarter, we were at 6.8, so not really material change. The real change there really was just in the non-core real estate, that new commitment that we saw on the left-hand side. On slide 28, which just is a graphical representation of our unfunded on the calendar year. Again, that 6.9 number was 6.8 before, not a material change there. The percentage part really spikes up just a little bit to 6.5, but that's really a denominator effect kind of thing because we've seen with the challenges of the valuation of the total plan. So nothing really materially different than what we saw before.
So Jeff, could you, for the audience, the denominator effect is the fact that this chart ticks up even though our unfunded commitments have not really tipped up because the denominator fell.
Yeah, so on the percent, on the right column, the percentage basis, so unfunded as a percentage of the total market value of the plan. That 6.9 number was 6.8 the quarter before, so not a real change there, as you said. The reason the percentage has gone up is because the valuation drop in the plan with the sell-off in public markets. So, to tie those together, not to change really in anything we've done and unfunded, just to change the percentage because of the total plan value. Okay. No, nothing really to talk about on 29. Let's skip past that. On 30, no exit investments to talk about this last quarter material there. And then finally on the slide 31, our top 20 managers, pretty consistent with last time. I think we were at 54.3 or 4 last time. So as far as our internally managed piece, which is the internal fixed income and the internal equity there, again, at over half the plan we manage internally. And then even going through the manager list there, there's no changes actually in the names on that list. A little jockeying on positioning, but everything remained the same from what you saw we sat down last quarter. Any questions on the performance review?
Questions? So, the temporary loss to market associated with fixed income portfolio, have you already gone over that, or?
We'll talk about it a little bit when we go into IG fix a little bit.
Sorry. Waiting on me.
Yeah, I guess next we'll get to that.
Hey, how are you?
I'm Tom Chevrolet. I'm former CEO of CM Benchmarking and currently a manager of special projects.
I guess spell your last name so that we get in the minutes.
Chevrolet, that's CHEIBELHUT.
Glad to have you. Welcome.
Thank you.
Yeah, I'll just set the stage real quick and then turn it over to you if you don't mind. So this is CEM benchmarking. So the folks, I think all the IC members have been around a while. We do this review annually where we take a look at our costs. We try to see how cost efficient the portfolio is. We compare ourselves to our peers. And we have CEM come and present typically every November. So this is what this analysis is. Just to keep in mind, this analysis is through 2021. So I want to make sure that that's clear because obviously a lot's changed since 2021. So when you're seeing some of the numbers, seeing some of the market values, they may look a little bit different than what we're currently showing. And then there's some performance numbers in here as well. And that's all through 2021. So those are certainly different than what we've just shown you. So with that, I'll turn it over to Tom to hit on the slide deck. So thanks, Tom.
Yeah, thank you. Look at performance, risk, and cost, but you've just seen the performance story. And all I can do is confirm, which is that your returns for the period in 5 years, 2021, were lower. And the big story was you had more fixed income, more cash, and less equity during a 5-year period when equities did better. But one of the things is you also had less risk because you had more fixed income, less equities. So you just saw the Sharpe ratios where over longer term periods, your Sharpe ratio for return versus risk were higher. So on the return side, I'm not going to be telling you anything new or the performance side, but on the cost side, that is part of the sweet spot. So, but who are we comparing it to? And on the cost side, I should tell you the story. The big story is you are low cost. You're low cost on an absolute basis of your 17 peers. You are the lowest cost of the 17 peers. But more important is, are you low or high cost on relative to given how you implement it? If your peers were doing exactly what you're doing, are you low or high cost? And there the story's the same. You're low cost relative to peers implementing the same asset classes by 5 basis points or 60 million. So your cost story is you are low cost. And not only that, your costs have gone down on an absolute basis for 5 years. And I'll get into some of those details. But before I get there, I want to just show you who's the universe and who are your peers. So if we get to...
Would you have me just instruct me to change the slide as you want me to go along?
Okay, so I would like you to move on to page 3. Because we just talked about the key takeaways from the next page. But the universe is 13 million funds. We've been doing this since 1990. So it's a 30-year database. And that's relevant, and it's global database. And it's most relevant when we're doing research, what are the characteristics of funded have value? And I'll touch on some of those findings where it's relevant to your results.
The 13 million funds.
13 trillion of assets.
Okay.
Actually, it's 12 trillion if I look at the chart more clearly. 12 trillion of assets. But when we look at your returns and performance, we compare you to a subset of those funds. In fact, we compare you to U.S. public funds within this universe. And the reason we choose U.S. public funds is U.S. has the same opportunity set, and public, we've excluded corporate because a lot of corporates are in wind down. So they're in long fixed income. They're liability matching, and they're just, they behave differently in funds that are going concerns. So for performance, we look at you versus a US public universe. For costs, size matters a lot. So if you flip to the next slide, page 4, we pick funds that are, we're here kind of in the middle of the group, and we've picked 14 US public sponsors from 70 billion to 335, but the median is 119 billion at December 31. And so we've picked funds that are your size because size is such a driver of cost. Big funds have a huge scale advantage relative to smaller funds. Next page shows returns, and I don't want to spend a lot of time on it. We've got 3 pages of returns and value added, and what you see is that your 5-year return is lower than it has been, but the story is, what's kind of interesting is if you flip to page 7, part of the story is asset mix, and here you can see that your stock, 5-year average stock was 42% versus a US public average of 46, and your fixed income was 37 versus 27. And this is your implementation allocation. But the reality is you also had some additional cash in your portfolio. So all of those things impacted your performance. But because of that, on the next page, page 8, you'll see that you were lower risk. In fact, you were at the 10th percentile risk. So much lower risk than most other US public funds. Next page. Value added, because you had the cash policy weight, you can see that in 2001, your green dot, 2021, your green dot was again at the 10th percentile, but that's going to flip this year because having more extra weighted cash has helped you during this past year. So I don't want, I've already spent more time on the return and value added story than I want to, because you've done it better already. So now let's move on to costs, which is the following page. Total costs. We look at costs so many ways. And the cost we use most often is your total investment cost, excluding private asset performance fees. We also look at them including private asset performance fees, but you'll notice they don't include private asset performance fees and they don't include transaction costs. And that's what we're benchmarking here. And those costs for you were 339 million.
Can you talk about why we don't include that? I mean, it's more of the historical data that you don't have, right?
We didn't include performance fees because for the first 20 of the last 30 years, people couldn't provide them. They didn't collect them. They didn't know what they were. We couldn't even do a good default estimate of performance fees because if you have enough, we can use a default. So one of the reasons we don't do it is history. But now we're starting to get good private asset costs, and we can and do benchmark them. But there's also the truth that the private equity or private asset performance fees can be quite huge and almost distort the story. To a certain extent, you want to pay performance fees. And so we look at it both ways, but we find the most insightful is to look at it excluding performance fees.
Would you say most of our peers are providing that now? That wasn't always the case, and we've tried to provide them as long as we've been doing this.
I would have to look at your peers, but I'd say at least half of our universe is now giving us pretty good performance fees, whereas a decade ago, so it's gotten much better. In fact, I think we get better performance fees than we get management fees, because people are still trying to give us net management fees, whereas we believe gross is a much better number. So we use gross management fees, and we will default somebody if they're not giving us the gross number. So first, let's look at how those costs have changed over time for your fund. So on the next page, it shows that the trend in your cost has been down. They've gone from 42.9 basis points to 28.3 basis points. So they've gone down 4 of the last 5 years, and the only reason they didn't go down last year was you paid more performance fees. And if you look at why they've gone down, that's the table on the right. The big reason why they've gone down is your asset mix has gotten to be lower and lower cost. You've reduced your holdings of private assets, which can be very expensive. It's not unusual to pay 200 plus basis points for private equity. And you've increased your holdings of fixed income during that entire 5-year period. And it's more common to pay 20 basis points for fixed income. So if you go from 200 basis point asset classes to a 20 basis point asset class, your costs are going to decline. And that's exactly what's happened. So your costs have declined by 14.8 basis points because you've shifted to a lower cost asset mix. That's the big story. If you go to the next page, it's just another way of looking at the same thing. And you'll see that your costs on the right-hand graph, that's just excluding all performance fees, they continue to go down. So the only reason they went up a little bit, ticked up a little bit last year was you paid performance fees in 2021 on hedge funds that were caused your costs to jump from the year before. But the long-term trend, excluding all performance fees, is down, down, down. And the reason is more fixed income, less privates. That's the big story. So how do those costs compare to your peers? The next page, 14, shows, that's page, no, oh, sorry, 13, my fault. It shows that your green dot relative to peers is below that 90th or that 10th percentile. In fact, your rank is 0 percentile. You're the lowest cost peer. So your absolute costs of 28 basis points compared to a median cost of 53, but they are the lowest of your peers. And you can see they're quite low relative to the US public universe as well. They're the 11th percentile. So on an absolute basis, you're low. But absolute comparisons aren't really that fair because we've already talked about how you have more fixed income. Fixed income's lower cost. And so a big part of the story is asset mix. So the real question becomes, well, how do my costs compare to peers if they were used, if I gave my asset mix to my peers, what would their cost be? And so that way economy of scale effects go away, asset mix effects go away, and that's our benchmark. So on the next page, we have a created benchmark that is what your cost would have been if we just given your asset allocation to your peers.
Tom, quick question.
Yeah.
So on the slide before there, we showed the absolute cost. How would we look versus, I guess, non-US public funds? I know we just compare ourselves to US public funds, which makes sense given that's the world we live in. Just curious, I know a lot of non-US public funds, they do a lot more internal. They have much larger teams. They outsource a lot less. Do you have a sense of, would we be low cost compared to that? Or
on an absolute basis, you would be low cost. But that's because not only do they do more, like the Canadian funds, they do a lot more internal, but they also do more private assets, and they do those internally.
Right.
But even if you're doing internal real estate, it's going to cost you 30 basis points. So you're already over your 28.3. If you're doing internal private equity, it's going to cost you 60 to 90 basis points. So that's over your 28.3. So some of the big Canadian funds, in fact, a lot of them cost around 80 basis points. And that's because they have a lot of private assets. That's Canadian funds. If you go to the Netherlands, they're probably closer to you in asset mix, and they're probably closer to your cost. They're less privates, more fixed, a lot more fixed income. And so asset mix is so much of a driver of absolute cost.
okay, thank you.
And that's why, hey, back to the next page, the question becomes, well, given your asset mix, are you low or high cost? And here, what we'd say is if your peers, those US peers were benchmarked asset mix, your benchmark would be 399 million. Your actual cost is 339, so you're low cost by $60 million. Nice number.
So I'll talk about this publicly. So this peer group is not worldwide,
This peer group is a US peer group, that is correct.
but when we say we're the absolute and relative lowest, is that US or is that worldwide?
That one is relative to the US peer group. No, yeah, it's the same peer group, US,
I should never use the word in the world.
and never in the world.
I should never use that term.
No,
Okay,
correct.
all right. All right, I just wanted to say the right thing.
By the way, I'd be bragging about it too, because it is. an
Well, I'm bragging on these folks that are in
Yeah.
this room, and
Yeah.
that's who I'm bragging on.
Okay. But I'm going to say that if I had a whole lot of Canadian funds in this peer group, instead of being low cost by 60 million, I suspect you'd be closer to normal cost, just because the Canadian funds implement in a really low cost fashion. And that kind of a segue to the next page. Why are you 5 basis points low cost relative to your peers, the US peers? And there's 2 things going on. One, you have a higher cost implementation style. And what does that mean? It's kind of a cascade, but you've chosen an asset mix. How do you implement it? The lowest cost is internal versus external, but most of your peers have similar internal, external versus you. But and there's also active versus passive. You have more active, less passive. That tends to be higher cost. When we look at you have, so you use more external management versus low cost income. That adds 1.5 basis points. You use more LPs, which are higher cost than fund of fund, than evergreen. You use more fund of funds, and all of this, they're little numbers. They add up to 3 basis points. It's not huge, but it does make how you implement your asset mix adds to your cost. And then why are you still low cost? Well, that's when you look at like for like. External active versus external active, external LP versus external LP, external fund of fund versus external fund of fund, internal passive versus internal passive. When we look at like for like, you're lower cost. You're lower cost for those external things, you're lower cost for internal investment management, and you're lower cost for oversight and custodial. And altogether, that's 8 basis points lower cost. So like for like, you're lower cost, and that's why your total, when we put the asset mix and that thing together, your total savings are 5 basis points.
So is it fair to say that we were in the same investment as our peers, we negotiated a lower fee than our peers on average?
For external management, entirely true. For internal management, you just paid less.
Right.
Yes, that is fair to say.
Who's laughing back there?
Me.
Oh, no, Sam started. Okay.
Okay, we look at costs 6 ways to Sunday. But this is, to me, the most important page. But there's 2 more pages I'd like to spend a few minutes on, but I'm going to go through all of them one at a time. So on the next page,
It's true.
this shows the details line by line of where you're paying more and less than your peers for similar services. And sometimes you are paying for the internal asset management and for the oversight custodian and other costs, you're paying less everywhere. But in the far right, it shows your external asset management, and sometimes you're paying more. Sometimes you're paying less, but more often you're paying less than more. And so this just has the detail. I don't want to get into the detail. I just want you to know it's here. So if there's not any questions, I'd like to move on to the next page. We also have detail of implementation style effect, but I kind of like the graph, and it also leads to a valuable research finding. And if you look at your fund versus your peers, you're not that different. So the fact that you're 3 basis points higher cost, it's subtle, but you do have more fund of funds. You do have more LP. So given your asset mix, you have slightly more of all the higher cost asset styles. And the research finding that we have found over and over is that paying more for active management does not get you more. In fact, what we find is that on a gross basis, all styles earn about the same. And so what happens is that fund of funds where the average cost is around 550 basis points, and LPs where the average cost is around 350 basis points of NAV. Well, LPs outperform fund of funds by about 200 basis points, which is approximately equal to the difference in cost between the two. But that continues. So fund of funds perform worse on average. In fact, on average, they destroy value. If you're top quartile, you're fine in a fund of fund. But if the average fund of fund destroys value by about 100 to 200 basis points, depending on the asset class. LPs do second worst. Then you have Evergreen does better than LPs. Then you have Internal does best of all. And the only reason is the difference in performance. Whenever we look at real estate, private equity, infrastructure, hedge funds, whatever, not that we only have two styles, but even their fund of funds does worse than direct. Whenever we look, the differential in performance is approximately equal to the differential in cost. So even though you have subtle differences, the fact that you have a high cost style does hurt, I predict will hurt you long term.
How much fund to funds exposure do we have?
Not a lot. You've got 1.1%. Your peers have 0.9 or 0.3. So it's peanuts. But
Yeah, just to give the group a sense.
These are all legacy, right?
Yeah, that's what I was gonna say. So just give this group a sense of kind of how we use this. We look at where we're high cost, say, okay, is there a reason we have more exposure to high cost investments? And take fund of funds, for example. We've de-emphasized fund of funds for really the last decade. We have some legacy fund of funds that, I mean, frankly, have done pretty well, and they're still in the portfolio and they're rolling off, but some of them take 10 to 15 years to roll off, right? So unless we wanted to sell them in the secondary market, they take a big, markdown to do that, we're just letting these roll off. So we have significantly less fund of funds exposure, to use that example, than we had 5 years ago. We haven't done really new investments in fund of funds, and we typically don't unless there's a good reason to do so. But we still have more than our peers have. So that's kind of why, and that's kind of what we take a look at all of this and we say, okay, well, why do we have more of this higher cost type thing? And sometimes there's a good reason. Sometimes, again, the implementation style is higher, but we've negotiated such a competitive fee that net, where it's not a more costly investment, right? So we do dig into this a bit, and we do take a look, and a lot of what we try to do is obviously trend down the higher cost type implementation and be more cost efficient where it's beneficial.
the other thing I'd like to point out on this page is co-investment. I think you're trying to increase your co-investment. Is that correct?
Yes, we have been, yeah.
Your co-investment is 1% versus 1.4% for your peers. So you have less, but there are a couple of stories. One, you're trying to increase it. I present to 5 clients, they're all trying to increase it too. And so it's become a more competitive environment to be able to increase your co-investment. So it'll be tough to do, but GPs are responding. And so, but to me, the key is to implement it at low cost, because I'm seeing some co-investment vehicles that suddenly cost 300 basis points instead of 0. And so once you start spending 300 basis points for a co-investment vehicle, what's the point? The other question that we've been asked is there a difference in performance? Like sometimes one of the theories was, well, they share out the dogs and keep the best for their portfolio. We're not seeing that. And in fact, we don't have enough to have statistically significant findings. But what we are seeing is that co-investment is actually during we only have about 7 years of co-investment data, has outperformed by an amount even greater than the cost savings.
I've been paying attention to this through Craig and others, and you're absolutely correct.
Yeah, so it's not, there is no negative selection bias that we're seeing. And so if that is your strategy, it's being shared by others, and the research says it makes sense. Cost matter. Next page. I love this question. Sturs Ohio also asked the same question, which is what would happen if we weren't internally managed? And how would that change our costs? And so it's kind of, think of it, if your internal management is saving you 34.6 million, because if you did it all externally and paid the median for what you do, your cost would be 34 million higher.
Did you use the term terminally match? Did you use the word terminally match? What's the word you used before match?
I might have said terminal, but I didn't mean it. No, if you took what you did internally, in the exact same
Okay,
styles,
internally.
and changed it to external. So you're, instead of being internal passive US large cap stock, you were external passive. Instead of being internal active fixed income, you were external. You pay more because your cost for internal for fixed income is half a basis point. To do the same thing externally would cost you 11.3 basis points or $32 million more. So you're saving 34 million by being internal per year. And I'm always shocked at how much time and energy is spent on internal costs and how little time and energy is spent on external costs. But almost always the internal costs are saving you money and the external costs are always much higher, but it's the internal costs that seem to matter the most. So this is just, and so I do like to point out, it is saving you money. Next page.
I think it tastes great and it's less filling for us. We do both.
There you go.
You're old enough to remember that commercial.
Tastes great. But the real savings, you're saving money in fixed income, which is the least savings you can possibly get. You know, like the 0.5 versus 11.3
For active management.
for active management. But the committed funds, they're the ones that are saving the most. That's because they're, first of all, more co-investment. Co-investment savings can be huge because if you're paying 0 versus 300 basis point, co-investment has a huge saving. But also if you're investing directly in real estate or investing directly in private equity, the savings are in the order of 300 basis points rather than 10 basis points. Just a thought to leave you. But it's also very hard to start investing in private assets directly.
Different staffing model too.
Very different staffing model. Okay, now the next page. This is a table of overwhelming detail that you received last year, which shows you asset by asset class, how much of your savings are due to implementation style versus paying more. And again, unless there's any specific questions, I'd rather move on to the next page. This is our final page. And this is where CEM benchmarking used to stand for cost effectiveness measurement. And this is our cost effectiveness chart. And it has 4 quadrants, and the really desirable quadrant is in that upper left quadrant because anything north of the horizontal line is positive value added. And you're right at for that 5-year period, you're right at 0. So you're on the horizontal line. And anything left of the vertical is low cost. Anything to the right of the vertical is high cost. And as you can see, about half our funds are high cost, half our participants are low cost. And during this period, more funds added value than lost value. But one of the questions is, does paying more get you more? Paying more relative to a benchmark. And as you can see here, it doesn't get you more. In fact, we've been looking at this. This is a 5-year snapshot. We've been looking at this for 30 years. Sometimes it gets you more, sometimes it gets you less, but more often than not, it looks like a shotgun, like it does here, where it doesn't get you more or less. But the point is, it doesn't get you less. But that's where we refine this analysis further. And what we found is, if you pay more for active management, on average, it does get you less. The other characteristics of funds that tend to add value, they tend to be bigger. You have to be a big fund to add value. And the final thing is, you have to play the game. You have to be actively managed. If you're 100% passive, you're neither high nor low cost. you're not going, your value added is going to be zero. And over the 30-year period that we've been looking at performance, there has been value added. Big funds on average have, the funds in our database, which are all big funds, I think the average size is about 20 billion. So a big fund database, they've added about 17 basis points per annum during this entire period. It's not a lot, but it's net. And net 17 basis points on $12 trillion is an awful lot of money. But that should also temper what can you expect to earn through active management. On average, it has been about 17 basis points net.
Is there ever a point where being large is cost prohibitive? Like you're too big?
We have not seen it on the investment side. We've seen it on the administration side where the bigger administrators start to become unwieldy. And so the economies of scale just stop. They don't go away, they just stop. But we haven't seen it on the investment side. Bigger continues to be better, but less. But again, very diminished. It's diminishing.
Right.
So it is a diminishing curve.
What's your intuition behind that question?
No, I was thinking it's probably not more of a cost question, but if you are extremely large and you're having to invest a lot of money, say in private equity, right? You have to invest a lot more money in private equity. At some point, you're investing in funds. You may not be able to get the size you want in every fund, so you have to do a lot more funds. So you may be paying more for some of those, I guess, smaller funds that you have to do. Or I guess it would be more of a performance question where are you investing in funds that won't perform as well because of the fact that you have to get so much money out the door? As opposed to, we always say we got to invest in top quartile private equity, right? That's where the juice is, right? At some point, that's not the case. And again, it's probably not a cost question so much as a performance question, but obviously those are
I think it is a performance question, and there's two ways to go. One, we have an Asian fund that is growing at 20% a year, and I think it's like $400 billion and growing. And it's just throwing money out the door and it's putting it in fund of funds. And then I can predict that in 10 years, it's going to underperform just because it's implementing in private assets fast and expensive. And I think I do believe they'd be far better off just moving it into equity because at least equity is liquid and fast. But the other bigger funds, at a certain point, you can't be internal at all if you're 10 billion. At 100 billion, you can start to be internal in quite a few asset classes. So I think part of the story is that you become more, you have more ability. The bigger you are, the more ability you have to move internal. But if you don't move internal, you're going to very quickly run into that performance ceiling.
Questions, Greg?
With the discussion on costs, I'm always reminded of the racehorse analogy that if you think of our investment as a racehorse and we're in a race, you can put a 300-pound jockey on a horse or you can put a 100-pound jockey on the horse, and that investment with that 300 basis points has got to go a lot further to make up all that additional fees and weight. So I'm glad we've got the smaller jockeys riding horses.
That's a good analogy.
There you go, Jeff.
So you talked about early on a little bit, this gets complicated. We're talking about overall total cost, right? And the performance cost kind of gets lost sometimes in those comparisons, and the concept that certain things in the private markets where paying more performance cost means you did really well.
Yes.
So whereas you look at it on an absolute number and it tells you a story with it. So is there a good way to kind of measure or quantify that performance cost piece itself, only given that there's a little bit of distortion in the higher the number, sometimes the better you did.
Okay.
I'm
going to cross a line that I try not to cross, but what we've seen is zero relationship between performance fees and performance. And where we have the most performance fees and performance is in private assets.
Right.
Yeah. we're just not seeing any relationship at all, because you could have 5 top performers and 5 dogs. And if the dogs are a lot worse than the top performers, that the net is, but that's one reason. But I think the bigger reason is we're getting much better costs, but we're still getting most of the costs we get are paid performance fees rather than accrued performance fees. So accrued matches performance. You know, it's a best estimate that year what the performance fee will be given your performance. But if it's paid, there's this lag between performance and what you pay. And even when we look at it over 10 years, there's still, because private equity deals have that 10-year time frame, there's always this 5-year mismatch between, even if we look back 10 years, there is a mismatch. So we're not seeing any relationship between performance. But the other reason, which I think is even a bigger reason, is the way private assets works. It's performance over a hurdle. Whereas when we look at performance and say, are you getting something relative to what you're paying? It's performance relative to an investable alternative. And so going over a 10% benchmark means nothing if the market went up 25%. So what we see is that there's very little relationship between performance and cost in private assets, actually in public assets too.
Any other questions from the phone?
Yeah, this is John Anarella. Thank you for your analysis. A quick question on a slide, a couple of slides back. It said something to the effect of evergreen, and I wasn't sure what that category included.
Evergreen is mostly infrastructure funds and real estate. It's those funds that never expire. So usually they would be core funds. So you'd be core investments in real estate with, as opposed to an LP relationship where they have a 10-year, as LPs tend to be value added. Real estate, they tend to have a finite life of say 10 years. So you go in, you develop, you sell. Whereas an evergreen fund, you invest in that fund and you stay in it indefinitely.
All right,
Yeah,
thank you.
that is something that we've been moving towards, specifically on the real estate side. So we have been moving towards that evergreen structure with a lot of our mandates on the real estate side. So it does provide more flexibility and a lower cost. So we do like those structures.
Other questions, John, or other members? Okay. Where are you headed from here?
Back home to Toronto.
Oh, good. I don't know your cadence or personality, but just a report you were looking forward to presenting?
Yes, it was.
Not all of them are like this, right?
Half of my funds are high cost. So it's always nice to have low cost and, in your case, neutral value added. But I always like the funds in the upper left quadrant, and we're likely to be there if you're low cost. So yes, it was fun.
Thank you, Tom. Appreciate you being here.
Okay, safe travels.
Have a good fall. Okay. We're now next to going to Jeff. Oh, sorry, Ben, excuse me.
Good morning. So this is this next item on the agenda is just a housekeeping, generally a housekeeping matter. So this is related to the IC charter update. So background, the Investment Advisory Committee is established by statute, Chapter 147, Section 69.2. And the IC charter is intended to implement those statutes and just talk about how the IC is supposed to run. The charter was last reviewed and adopted March of 2017, so about 5.5 years ago. And so, again, housekeeping matter, it's good to review your charters or policies every once in a while to see what needs to be updated. There's a few things in the charter that we went ahead and updated, and I've sent a red line version to all the members of the IEC. Specifically, we corrected a few names and a few grammatical issues. There's certain reviews that are required every other year, but in the charter they were listed as biannually, so twice a year. So that was unintentional mistake. There's also, we added some statutory references to be clear what the IC's statutory authority is. And we added some flexibility related to member attendance, and then clarified voting process. So majority vote, roll call, et cetera. But that's, and we also cleaned up the compensation section to more clearly align with what the statutes say related to per diem and expenses. Any questions or comments from IC members?
Any questions from the floor? I mean, from the phone?
Not here.
All right, thank you.
Thank you. Can you give a shout out to people who helped you with that?
Yes, be happy to. So Laura Rowe on our legal team, she regularly does excellent work helping us correct charters and policies and things like that. So she did a number of these corrections. Also, Jason Sass reviewed these as well. And I also talked to various members of the legal team, other attorneys who support some of the boards and commissions related to our office, so Reed Chisholm and Joel Heimbach. So as usual, is a group effort.
Thank you very much.
Yeah, thank you.
All right, now we're on to Jeff.
All right, we're going to chat some here about the investment grade fixed income review. With the backdrop, definitely the most challenging time for that market in my 31 years here for sure. We'll get into a little bit of that, but I'll let Brett Hall, Assistant Director, I think all the staff obviously knows that here. So I'll let him kick us off a little bit and talk a little bit about our short-term fund first.
Sure. The slide that you have up right here is our quarterly one pager that we provide to all of our STIP participants. Just as you'll recall, by policy, the STIP maturity range is 0 to 5 years. Currently, that average maturity is 0.9 years. So on the first chart on the top left, you'll see the historical annualized net cash return for the STIP. You'll notice that the rates have been steadily improving here. Basically, short-term rates are up dramatically with all the Fed moves that Jeff and Chris have mentioned. Rising front-end rates, reinvesting in higher yields. The STIF rate has increased over the last year to 1.58% as of quarter end. And a year ago, we sat here reporting that the STIF rate was 0.18, so there's been a dramatic increase there. We do expect the STIF rate to continue to increase as we continue to reinvest in higher yielding, higher rate environment as well. So as of October, the STIF rate was 1%. So moving to the right, you'll see the STIF allocation. As always, the assets are allocated across highly liquid securities. Just rolling through there, the repurchase agreements. This is our portfolio's overnight cash vehicle. We manage that basically to meet immediate liquidity needs. Currently, we're rolling about 1.5 to 2 billion daily. As a reminder, this is repurchase agreements are collateralized by treasuries and agencies. And it is delivery versus pay. The treasury portion of the portfolio is basically managed for additional liquidity. We have a front-end ladder where we are laddering out about $2 billion per month of off-the-run treasury notes. Also worth mentioning, we have a pretty significant amount of T-bills maturing within 3 months, roughly about 9 billion or so there. The agency portion of the portfolio, this is predominantly callables where we're investing excess cash, basically cash that's in excess of current liquidity needs. It is worth noting that that portion of the portfolio has increased. Last year when we sat down, that portion was about it was actually at 15% of the portfolio. And we have increased that, basically doubled that. And we've been opportunistically investing in higher spreads there. Basically, spreads on callable agencies have widened, also basically taking advantage of instances where volatility was a little bit higher there. So below, you'll see some portfolio characteristics, which I won't run through unless there are questions. Next slide. So we've shown this graph before. Basically, this is the stiff rate history. It's worth noting that assets under management as of 52.9 billion. So I'll draw your attention to the red line, which is the stiff rate history there, as well as the yellow line, which is the iMoney Net composite. Also, for your reference, there are comparable treasury rates as well. You'll notice, as we mentioned, that basically all short rates have increased on the far right side of the screen here. Just as we've reported in the past, and it's worth noting that the stiff will outperform comparable rates in most normal rate environments. And this is due to the normally positive shape of the yield curve and our ability to basically go out the curve and pick up yield. The instances where we underperform are basically where rates are rapidly rising. And this is the situation that we're in right now. So, the stiff rate, as I mentioned, was 1.58 as of quarter end. iMoney Net composite rate benchmark was 2.85. 6-month bill was 3.9%, and the 1-year constant maturity treasury was 3.9%.
I think the fact that we manage this on a cash return basis, you see the red line there, and historically a fairly material jump over what you'd get in like a true money market type fund. But like Fred said, the periods where we get that rapid increase, it takes a little while to cycle that money back out at the higher rates on it. So whereas that's an immediate change in the other funds. So it's the same pattern we've seen before when there's a rate increase. And we've seen the pace has been unprecedented, 375 basis points in 8 months. So we're putting that money back to work at higher rates now, like Fred said. We've got a large amount of money coming in here over the next 3 to 6 months that will go out in a higher rate environment. So we'll see that trend line kind of resume what we've seen in the past over time in the portfolio. But it's funny when he brought up we sat down a year ago to talk about fixed income, that it'd be an 18 basis points. Now we're in this rate environment with high short end rates. And it really wasn't long ago, we were sitting on the desk wondering if we could do a 0 rate for repo. And now it's way different from that now. So big change. Moving on from the short-term book, talking about on slide 4 there, the investment grade fixed income portfolio as a whole. On the top left is the pie chart. As a reminder, we've really for quite a while now been running kind of a 90-10 split would be neutral, meaning 90% core, 10% in our non-core, which has been for a while just that really cash and stiff. You can see where that number's up to pushing 13% now as part of that non-core piece. Really is a reflection of how poorly and how rough the market was for the core portfolio, and what we've seen in valuations really helped push that percentage number. And because of that, we haven't really wanted to move any money back into this point, but we're at the point where we're looking for other alternatives. And I'll talk a little bit at the end about one thing we're doing with some of those assets in that orange slice of the pie here at the end. Ratings wise, on the top right, you can see where we are relative. We're still underweight treasuries. The corporate book, we've moved up slightly from when we sat down last time, a little 1.5. Again, we could take that to 5. Feeling pretty constructive about where credit valuations are right now. And just running
5 because of
by policy, we can go over or underweight 5% in these areas.
Okay.
In the core portfolio, right?
We're saying corporates can only be 5%.
No, this is a relative weight to the benchmark, so 5% overweight. When we did that would have been when we had spread blowouts from the financial crisis, or we took it up a lot when we had credit blowout at the beginning part of COVID as well too. So, the real ugly scene, I guess, we talked about it a lot already, but on the return side, we see on the bottom left here, again, that 1-year number on it. Really the worst year for fixed income since the inception of when we went mark to market in our portfolios here at the plan, which was 97. And I'll show you some historical numbers on that. On it, you can see, so basically blue bar is IG fixed income as a whole, includes core and cash. The 1 year down 14.5%. The benchmark down though significantly more than that, down to 17.3. So just that real challenging environment we had. So how do we do better at that 14.5 versus the 17.3? It really was driven by what we talked about before. We were short relative duration of the portfolio. We had an elevated number of cash within fixed income, and all those things were a favorable spot relative to where we would have been if we would have run it straight passive.
Jeff, question, we've talked about this before. Down 14.5% that's because you're marking that security to market.
So we'll,
If we held that security to maturity, we don't have a loss.
so I'll give you an example of one place would be, that is correct. So we're going to get mark to market value. In the case of everything we're owning, we know that the, what I'll call the terminal value or the maturity value is going to be par or $100, let's say, right? As an example, in our corporate book, which is $9.5 billion, Brett pulled together, the average market value in their mark is 88 cents on the dollar or $88 and $100, right? Barring defaults, that bond will mature at par. So yes, much of what's marked to market value over time will resort back to its maturity value at par over time too. So
We would only have these losses if we sold these securities today.
measured over an entire holding period, correct. But your mark to market value is a reflection of current marks at where yields are and spreads are. But we know that the maturity value would be at the end of the day par, which would be in this case, in this sense, $1 on it versus 80.
Right. Thank you.
And never in my lifetime have we actually dollar cost average in fixed income portfolio.
Right.
You talk about that cushion that given these will mature at par. And in addition to that, we're buying.
So I mean, we're buying stuff, we're able to buy things there, but the yield that we're buying it at is reflective of the current environment that we're in. But what's happened is because most of the old things in the portfolio and really that are in the market as a whole that you're buying the secondary were issued in a different rate environment with different coupons on it. So, you know, what that meant is as rates went where they did, everything basically then went to a discount. And if it's issued and vice versa, new debt that's out there, maybe was issued in a 1% world, if rates are at 4%, the only way you're going to earn that 4% because the fixed coupon is set is if it trades at a discount. So that's the bulk of what's happened, what's in the portfolio as a whole. And that just kind of elevates up the market today. So yes, those things are, you know, not to say, I guess, kind of paper losses or whatever, but unlike in equity where we don't know the terminal value of the holding maturity, with a bond and the maturity amount, we know what it's going to mature at the end of the day. So it's a good question. On slide 5, looking at
There's some optimism in that.
yeah, well, and we've got some other good things to share kind of at the end about fixed income going forward here. But turning to just focusing on that blue part of the pie chart we saw at the end of there, looking at the core portfolio, structurally here, not a lot different than what you've seen before. The biggest difference is that the yields on that book now is much higher than we saw in the past. We'll get into that a little bit more. We're still short duration. We've had the desire, we're at 7.5. The core index was like 8.9. We have some desire to start taking that out farther, but honestly, as we've gotten higher prints and this needs extended a little bit on inflation, we've been a little slower to kind of make that move on it. But anticipate that where yields are, that we'll start to resume and look more like we have in the past, and especially as the yield curve gets more positively shaped. So the backdrop on kind of how we got to this return market we've been in is really driven, pictured here, and where we see rates go. Dramatic trend forward. This kind of captures the last year, and the rate has just been trending higher and higher across 10 and 30 years from where we started, you know, in a 1.5 time frame here to at the top right. They're kind of hard to read. We're at 412 now. This was done about 2 weeks ago, put this together, but 412 there, and we're 426 now the long bond. So it's just been a rapid, steady increase in rates over the last year. And of course, rising rates is bad for bond prices, and that leaves you where you are return profile. On slide 7, again, different look at the yield curve here. Again, kind of really measuring out since we sat down and talked about fixed income specifically last September. And we can see, don't be fooled by the scale on the bottom there, as it looks like the 30-year wasn't up that much on that bottom scale, but if you look at the left, it's up over 200 and kind of captured. So really just an incredibly dramatic move over a 1-year time period. I always like to look at the presentation we'd had a year ago, talk about what expectations were then. And one thing we show, and it'll be coming up, as we show this buying yield forecast, which is a consensus estimate out of Bloomberg different providers. I will tell you that we see what the 2-year was up over 400 basis points. When we sat down a year ago, the consensus expectations for the 2-year was up 15. The consensus estimate for the 10 and 30 years was up 50. So nobody was remotely close on what would happen. And that was obviously all driven by what we saw in inflation versus what expectations were a year ago.
Great. Next slide. So on this chart, you'll see the spread history for the credit markets. As Jeff mentioned, last time we sat down, credit spreads, we were talking about credit spreads tightening. In this presentation, we're talking about credit spreads widening out. If you look over to the right side of the chart here, over the past year, credit spreads have widened significantly. Year to date through 9/30, high yield was out 230 basis points to 543. Investment grade fixed income was about 70 basis points wider at 167. As of 10/31, high yield spreads were about 10 basis points wider. The investment grade had widened out only like 1 basis point or so. Basically, all spread product was wider. Year to date, all sectors within fixed income were wider. Kind of leading the way there were interest rate sensitive sectors such as banks, financials, and REITs. Other sectors were also wider: autos and leisures.
And for IC members, as you hear from Ron in a few minutes, this graph about credit spreads is not just about IG fixed income. It affects a lot of other things in the portfolio.
Next slide. So we've shown both of these slides before. On the top, you'll see basically corporate relative value. On the bottom, the LTIP allocation by sector. Start with the top graph. We do monitor relative value within corporates. Just as a reminder, this graph is basically sector spreads versus average index rating. And as a reminder, if a sector is above the line, it's considered cheap. If it's below the line, it's considered rich. If it's on the line, it's considered fairly priced. So the entire curve has shifted this year upward. Most notable changes here are in banks, which basically moved from fair value to cheap. Tech and retail also moved from rich to fair value, and energy moved from cheap to fair value. So moving on to the graph below. Basically, this is where we monitor sector weights relative to our index. The long-term portfolio is in blue and the index is in red. Our relative exposure by industry is considered fairly neutral. There's greater than 1%, and really there are no material changes here.
So it's worth saying that kind of the way we're set up structurally to manage everything actively. So the two team members, market doesn't close, so my folks are still up top. We got new issues today. So the other members of our team, which I think everybody's met in the past, two of them being Carlene Hughes and Mike Nichols on the credit research side. So basically the coverage with industries are split up across those individuals. And then we're making active decisions around weightings on where we're going to be in the sectors and also on name specific. So, a lot of the excess return we've generated coming out of Corpus is because of the work of that team as well, and the work they've done on knowing these credits and kind of letting us actively position where we want to be in different names on it. So jumping forward to slide 10, this is never really haven't seen it before. There's a lot going on, so let me walk you through it. Why I think it's interesting information. So when we talk about building out the asset allocation model, one of the things you have to have on the inputs is return expectations. And you've probably heard me say before, like, whatever your current yield and maturity is on your portfolio is a great expectation baseline for what you think you're going to earn over, especially like a 10-year period. So kind of keep a running data set on that to kind of go back and back test it. So the data on the left in the column is really, what I'm using here is actually the domestic master. It's not our benchmark. It's a longer term one. There was more history on it, but it basically would look like the Bloomberg app. It's just kind of like the art credit. It's mortgages, it's treasuries. And what the data set is here, so for each year, you have the yield to maturity at that year end. So we'll start up at the top there at 1985, right? The yield to maturity at that time was 9.29. What did you earn the next 10 years, that portfolio, or in that index? And the answer in that period is 9.63. So if you go down this data set, looking all the way down, you'll see that it's very consistent on within, in most cases, 1%, or 100 basis points on what you'd earn. So really that philosophy on kind of building out current yield to maturity is what you're going to earn in fixed income really bears out. You can see that graphic in the data up top. So I think the first question you might think was, and why we really want to go back and dig at it was, well, gosh, we just talked about bonds are down 15%. Surely that got blown up at the end of the day on it. The reality was, if we look at the number in 2012 at the end of the year, the yield at that point was 1.5. And our return the next year to date as of 9/30 has been basically 1%. So despite that, really, it all kind of still came out in the oven that it's an expectation of what you're going to earn. So why is that good news? Well, if we look at that same data for 1019, the yield on that book now is over 5%. So you've got to go back quite 15 years roughly. So you find a period where our expected returns in that asset class are that number. So I think the silver lining and everything going on is going on in the kind of the bloodbath of the market is now we're in a position where this low risk asset we have in the plan is going to have a higher expected return going forward than we've seen in 15 years. So I think things are optimistic to the point we're making earlier in this asset class, more so than we've seen in quite a long time. So it's the positive. So it's good to go back and kind of back test and look at that. Flipping forward to slide 11, this is kind of the bad and the good, I guess, the ugly here. So up top, again, showing the perspective on how bad it was. This is the yearly return in our core fixed income book by calendar year back to when we went total return. And obviously, the outlier in 2022, that negative 60% is just ugly at the end of the day. And what happened in the market? If there was any good news in that, the bottom chart captures our relative return to our benchmark for each calendar year. And we've certainly had a track record of adding value over time, but even in a rough market, I think this is probably the best job that the team has done. 300 basis points is really dramatic for us relative to everything else. And you say, well, we're still down that percentage number. Well, I think the good news is if we didn't do that and we just had a passive implementation and weren't active, that roughly equates to about $900 million in the plan. So, you know, there's some good news in that story. I think we talked about how we were positioned. You know, we'd be the first to say, even back the data, nobody really thought it was going to be this ugly, but at least I feel like we were on the right side of things for what happened at the end of the day on it. And I will tell you that number through October is even bigger. We on a relative basis, because there's continued to be challenges, we picked up another 50 basis points in October so far. So feel really, it was a rough period for the market, but at least feel good about that we made the best of what we could within the context.
So you're saying if your plan had been down as per the performance of the benchmark, we would have lost another $1 billion almost.
Well, about 900, close to $1 billion, yeah.
Thank you.
And that's just in the core book as a whole. Really, there's a little more value in that. We have more cash in the non-core as well too. So, but there's some pops in there. On slide 12, apologize, this doesn't read too well. We brought it over from the Fed's website there, but
Probably doesn't mean much either.
probably doesn't. But we'll walk through a couple of data points and I'll contrast them with what we were at when we talked about fixed income a year ago. So in the bottom left on the Fed funds rate, kind of see that median projections, and that 2023 is the middle box of the years there at 4.6 for a year from now. That number last year in their projected data was 1%, 3.9 for 24. That number was 1.8%. So we've seen obviously a material shift in where the expectations were going to be on Fed funds rate from a year ago. If we look at the ranges for 23 and 24, kind of moving to the bottom right side over there. In 23, that range number was 0.1 to 0.6. Now it's sitting at 3.9 to 4.9. On the core PCE number, kind of an inflation number they like to use there, again, back on the left, you can see where those numbers are for 2023 at 3.1 and 2.3. Those numbers were anchored at kind of their normal 2.3 to 2.2. So I think we can take the data from the latest meeting and say, obviously, things have changed on expectations. But if you look at their runs and where they still see inflation tamping down 2.3, 2.1, it matches up with basically what seems to be a relentless approach with the Fed funds rate to tamp down inflation. So there's not going to be any let up there, I think, in the near term, I guess is what we're getting at for. Turning towards slide 13, which captures the dot plot again. This data, the data up top is the current one in the yellow there from the 9/21 meeting. And then the gray bars at the bottom represent the meeting from they had from September 21. Again, you see that echo of the change in projections from the Fed from a year before. No material long-term rates. I think, there's still a tremendous amount of dispersion because each dot represents a different Fed member. A lot of dispersion in that 2024 where they think Fed funds rates are going to be on too. But again, just kind of demonstrates how dramatically things are different from that. So I'll tell you what we're looking at the futures market on that, on what more is to come. So the December meeting, it was running closer to 3 before the last Fed meeting announcement and the increase. And after the comments on that and things going on the market, that number is basically at 2.25 on projections. So basically thinking we're going to see better chance of 50 to 75, but in that range. We move to February of next year, just under 4 increases, so just under 100, 75 to 100 total between the December meeting and the February meeting. And the futures kind of point to basically looking out into the next year that we'll see basically from where we are currently a total amount of maybe 125 basis points more increases. I take that with a grain of salt. The readings, the inflation readings and what happens are going to determine what that number is going to be, but that's where at least the market consensus is right now. Moving on to slide 15. Excuse me, slide 14. Take a look at the increases for where things are in the consensus. I talked about how off the consensus was last year at this data, but just taking a look at it again, so we just have some sense of it, is really expectations that we're going to see some moderate decrease going into a year from now, decrease kind of across the curve on it. On that. And then taking down the bottom below, which is capturing the break-even rate. So we saw a spike on that number. Obviously, we saw these high inflation readings coming into the year. And really, what the break-even rates, so the difference between tips and nominal, kind of signals to me is that we've seen it tick up a little bit, but the market's basically telling you that they're believing the story that they're going to choke it off. Because if not, then the break-even rate should be higher at the end of the day when you get paid. And then lastly, on slide 15, we always like just take a look and see. This is just a baseline simulation for 1 year. We talked about what we think is now yields in that 5% range. We think the long-term return will be in fixed income. Well, what would the return profile be in the next year, depending on what happens with rates? So this is just a base simulation. Assumes the curve is going to move parallel, and there's no change in spreads. But you see a breakdown here of what the return expectations would be roughly in the core portfolio for rates. Obviously, rates increase, you're going to see weaker returns, and obviously rates drop, you see more positive returns. The big takeaway on this chart from last time is in a higher yield environment, we're getting a more income component. Last year we sat down, this chart had a very small percentage of income component because yield was so low at the end of the day. So you get a little more buffer, so to speak, in kind of in a price rate change. So, we kind of see this as the, I would say roughly a 4 to 6% kind of thing for maybe a 1 to 5 year. And we, kind of consistent thing for the long term in the yields. Again, tips market shows inflation declining from currently high levels, but still remaining a little bit elevated. You saw that in the last chart. It's kind of a summary backdrop of where we are in the fixed income. Again, do think that certainly better days lie ahead on, but you can't understate how dramatic of a market it was that we've never really seen this kind of numbers before in that marketplace as a whole.
Questions from the phone?
Let me get one thing I didn't touch on. before we take some questions. So I didn't mention one thing we're doing. So I mentioned earlier that orange slice of the pie. We looked at the investment grade portfolio, that non-core piece. The one opportunity set that we've been pursuing that is a little bit different. And that is, we talked about where we thought spreads were attractive, and you saw where the yield curve was. So one thing that we've been focusing on is we feel like relative to those proceeds in our STIP portfolio is looking at short investment grade credit looks really attractive to historical numbers on it. In the range pushing from 5 on up to 6%. And we think that's an attractive thing for our non-core book. Certainly the risk profile, shorter duration than anything else. So we've been pursuing and
Duration of 4 to 8.
yes, in most cases on the shorter end of that. So we've been using some of that non-core allocation, trying to put that to work, much like we did when we had that allocation when spreads blew out. We did it on the longer credit and intermediate credit. In this case, shorter on that. So we've put roughly $600 million to work in high quality investment grade credit in that non-core book with yields anywhere from 5 to 6% range. And that's something that we're excited about the opportunity, and we'll see how long it plays out. But something different that we've been pursuing within that non-core piece of our investment grade fixed income.
Thank you for doing that. I know it's been a heavy lift, but I look forward to hearing.
All kudos to I mentioned Carlene and Mike, but also I want to mention Brad. You know, Brad have been doing all the heavy lifting on digging through and trying to find inventory, and a little bit different experience when we had early COVID when spreads really went. You saw the charts, remember, went crazy. We had liquidity and cash to put to work, and we were kind of one of the only buyers. So it was kind of name our price and take everything. There's been a little more fight, a battle to get find opportunity. So kudos to the team for digging through that and getting that to work in the ground so far. So.
And I look forward to that being over $1 billion.
So we're working on it.
Any questions to the floor from the phone? Excuse me.
Yeah, hi, this is John Anarella. Jeff, you're probably salivating with these yields compared to what we've seen over the last 6 to 8 years. Hopefully this makes your job a little bit easier, makes everybody's job a little bit easier going forward. If it makes you feel any better, I've read multiple times that this was the worst government bond market since the Revolutionary War. So that's a long time. And I guess the bonds fluctuated depending on the battles won or lost. But a quick question on, I guess about a month ago, when the Bank of England had to step in to help the pension plans in England because they were stretching for yield and doing some pretty aggressive things. We're not doing any of that. We're pretty plain and vanilla and conservatively managed.
That's correct.
Okay. Yeah, I think that's really important to know because a lot of pensions got caught pretty short with their rapidly raising rates in England, and obviously we're even more aggressive here. So,
yeah, our approach on the core portfolio has not changed a bit. The instruments we're investing in, certainly we changed, and we talked about in there, taking some of those exposures up and down, but we stay straight within basically our eligible universe in the benchmark, which does not include anything, like we're talking about here. Then we didn't see, obviously, there's the pressures over there around possible new policies that were being implemented and how that affected the tax revenues that could support their debt. And so kind of a little different model over there. I would say if there was any impact there, as you elevate risk around globally, you see some pressure around credit spreads. And certainly there's even in the investment grade indices we have, there's dollar denominated, European companies and global companies in there. And you see a little pressure on that, but nothing like we saw, directly in their debt. As you're commenting on the environment, yeah, I would say that if today we're salivating, we have our mouth for quite a few years, so we're certainly more excited about the opportunity set.
Yeah, well, for my opinion, and I think, for the pensioners and the public looking on, you take your hits sometimes when the markets are really rolling and you're conservatively managed fund. But as the treasurer has stated numerous times, he's in the check delivery business. You all are. And, being conservative is a good thing, especially when we're having unexpected things happen in markets, which tend to happen regularly. So I give everybody, tremendous credit for the cost savings that's gone on over the last several years, as well as, kind of sticking with more conservatively managed and not reaching for either yield or excess returns. So.
Thank you.
Thank you, John. Other comments from the phone? Jeff, Brett, thank you and your entire team. We appreciate it very much. And comment from the phone?
As always, great work, guys. Thank you very much.
Thank you.
Next, we'll have Ron and his folks come up. Without objection, we're just going to keep rolling if that's okay with everybody. Good morning, everyone. It gives me great pleasure to get an opportunity to present to you a little bit about the history of the opportunistic fixed income portfolio, a little bit of history around why it's in the portfolio, a little bit about the performance, talk to you a little bit about the current market environment and what it is we're looking forward to on a go-forward basis. Before I get into that, I'm typically joined by Todd Powers. Unfortunately, Todd Powers had a really cool opportunity external. He took advantage of that. He's going to be hard to replace. He's a strong value-added member of the opportunistic fixed income portfolio. But I'm also happy that we've been able to add to our analyst pool. We have John Krudowig with us. He's been great since joining. We continue to recruit and want to add to our portfolio management staff. But we're excited about what the past has presented, but also what the future holds with us as well in the future. And so those will be some of the things that I will kind of reiteratively say throughout this presentation, how kind history has been, but how good the future can be if we work together and continue to be focused the way we have in the past. This particular slide has been in pretty much most of the slide decks for the past several years. The reason we put it in there is to not forget the reason the portfolio exists. This particular portfolio launched in 2009 as a way to diversify fixed income and equities in an environment which we expected at that time interest rates to be rising materially. We thought that non-investment grade fixed income would be a really nice way to offset a negative impact of having a long duration fixed income portfolio. And 10 plus years later, it's good to see again that some of the things that we put in place years ago are actually working the way that we expected or hope for them to perform in a particular environment that we're currently in. Also wanted to focus on capital preservation. Capital preservation is something that has historically been kind to us and hopefully in the future will be kind to us. But there are definitely moments where we're conservative, whereas the marketplace is not as conservative, where we may lag certain benchmarks in different short time periods, but over a long period of time, multi-year period, hopefully our performance will match or potentially exceed. Next slide. On this particular slide shows the left-hand mix how we categorize most of our fund investments. We typically categorize them across traditional corporate credit, distress, hedge funds, and special situations. The last several years, distressed credit has been less of an emphasis. Hedge funds have been a longer term emphasis for us. Special situations is an area where we typically shine. Typically, I rarely talk about the right-hand side of the page, but the right-hand side of the page
is a mix of particular strategies, securities, things that we can invest in. But I'd like to bring your attention to bank loans. Bank loans have been a safe haven for us in this rising rate environment. Bank loans typically have floating rate coupon features, and that has been definitely a place that has mitigated some of the price action that has taken place across fixed income for us, because the price action has been offset by higher coupons and things of that nature. Structured credit on the right-hand side has typically been a place where we invested earlier in the last decade, and we kind of moved away from that. But on a go-forward basis, there might be an opportunity for us to spend some time in the structured credit space. And also on the bottom right-hand side, direct lending and dislocation-oriented strategies have been really, really a place that have added value for us in the recent years. Next slide. As of 9/30, even today, pretty much our portfolio has been underweight. It would probably take us approximately $500 million in order to get to target weight. We've been having conversations with the treasurer around increasing our exposure even beyond target weight, trying to put together a glide path that will allow us to get above the target of 7%, hopefully getting closer towards a 7.5% target weight, given the opportunities that we currently see, given the conversations that you had previously with the investment grade fixed income staff around higher yields and higher expected returns in our asset classes. And so we'd like to do our best to help the overall plan take advantage of things that are currently in our wheelhouse right now. This particular slide shows the diversification over a period of time and how our assets have grown since 2010 till now. You'll see it's been a slow and steady growth across various sub-strategies that we hold in our portfolio. You'll see that distressed credit has been de minimis over a period of time, and we may be moving into an environment where distress may be a more pronounced piece of our portfolio. Additionally, you'll see where traditional corporate credit increased in value the last couple of years. That's been primarily due to some of our dislocation mandates that we've been able to take advantage of with the help of the treasurer. So I like to say dislocation-oriented mandates have become a theme across various LPs and GPs. And I'd like to say that North Carolina retirement system has been a leader in that initiative. Several LPs are calling us to ask us questions around how we think about dislocation opportunities, how we structure different SMAs without managers and things of that nature.
Our competitors are calling us?
Yes, sir. It's typically.
But they're in there.
They talk to us. We share notes. They help us with things. We help them with things. But North Carolina has been an innovator in new product development. The private equity team has innovated, done some things in the secondary space. We've done some pretty interesting things in our portfolio. So dislocation mandates are not the exception. It's typical. If you look at the bottom here as well, you'll see the growth of our manager relationships and the growth of our funds. Typically, going back to the inception of the portfolio, we've been hovering somewhere between 10 to 20 managers in our portfolio, and that's been by design. We've been focused on fewer managers, but expanding relationships with those managers. That gives us incremental control, that provides incremental fee savings. It gives us the opportunity to customize things the way we need them to be customized. And to be honest with you, it gives you an opportunity to focus all your efforts on things that really, really matter and move the portfolio, rather than being diversified in too many areas. I'd like to showcase the performance. The top half of this chart shows our annualized performance over 1, 3, 5, 7 since inception. You can see that in each of the categories and time periods, our portfolio performance has outperformed the benchmark. Some may be skeptical about our benchmark, but hopefully the next slide, which we're not going to yet, I'll be able to allay some of your skepticism around our benchmark and things of that nature. You'll actually see or believe that our team has generated a reasonable relative performance to our benchmarks and a reasonable absolute return relative to the risk that we've taken in our portfolio. The bottom half showcases the calendar year performance on a year-by-year basis since inception. As you see on the left-hand side, earlier years, we've materially outperformed the benchmarks on an ongoing basis. And at subsequent years, most recently 2019, 2020, we underperformed our benchmark on a go-forward basis there. And then SubBank materially outperformed it in 2021. The thing I like the most about this particular slide is during the drawdown years of our benchmarks, we've been actually able to have a lower drawdown than our benchmark. The thing that worries me sometimes is that sometimes the risk in the benchmark, if we're not able to invest in those assets following a drawdown of the benchmark, those particular securities may be the securities or strategies that outperform the next period the most. And so that's kind of something that worries me about this particular calendar year, where many of the opportunities in high yield and other securities that we could be involved in have had a meaningful drawdown relative to the performance that we've experienced. And as they recover, they may actually have higher performance on a go-forward basis. But we're going to talk to you about ways we mitigate that through our manager lineup and through dislocation-oriented strategies. Next slide. This is the slide that helps to debunk the performance of our benchmark relative to our actual performance. The items in red showcase the mix of U.S. high yield, which is a very straightforward index. And it also shows the Credit Suisse leveraged loan index. Those particular two items pretty much represent our universe. We can invest in, or our underlying managers can invest in high yield, or they can invest in leveraged loans. And then the lighter red, the orange one, is a benchmark showcasing hedge fund relative value index. And so you'll see that over a 1 year, 3 year, 5 year, 7 year period, and since inception, the items in blue, which represent the performance of the subcomponents that we invest in, are materially higher or at least equal to most of the things on the right-hand side, which are the investable universes that we break out. And so over a long period of time, we've done really well across most segments, but history has been kind to us in the special situations period or bucket, mostly because that bucket, our managers take advantage of what's happening right then, or they take advantage of the dislocations that are currently in the marketplace. Whereas hedge funds have not been as strong of a performing asset class for us, but hedge funds have typically performed very well during drawdown periods. So in aggregate, our portfolio has done reasonably well, but our team has done really well in special situations and distress. But distress is not a major part of our asset class, given the environment that we've just gone through, but on a go-forward basis, may be a higher percentage of our portfolio. Moving forward. This particular slide highlights the portfolio characteristics. Most of our portfolio is in senior debt. So, and you see over to the right-hand side, we only have about 16% exposure to equities, reorganized equities. That can be part of our asset class. It's not a meaningful part. Equities are not a meaningful part of our composition. It's something that we actually try to shy away from, or try to guide our SMAs away from equity-oriented positions, given the volatility. But it's good to see that a lot of our exposure is senior in the capital structure, underlying our objective of capital preservation. Also, you see we have a huge exposure to North America relative to our exposure to Europe. History has been kind to us there, as Europe has gone through some trouble here lately. And maybe on a go-forward basis, Europe may be a larger percentage of our exposure, as managers may opportunistically move capital from other geographies and take advantage of the issues going on in Europe. moving forward. You can see we're diversified across various sectors here. Pretty evenly diversified. There's some things that stick out like financials, but that particular category is pretty broad once you dig all the way into what comprises this financial sector. Next section. This is credit market update, broken out by the several categories that we typically allocate capital to. Within private credit, this is where we have our allocations of senior secured debt. A lot of our managers are doing pretty well in this particular category. We believe that this category will be an area of forward emphasis as banks are pulled out of the marketplace. There's been significant less issuance this year across structured credit and primary issuance for bank loans and high yield. But we believe that our private credit managers stand to take advantage of the lack of issuance in more syndicated markets. Structured credit over to the right, we believe that this particular area will be very volatile on a go-forward basis as the underlying loans and structured credit that they've supported over the last several years has deteriorated. However, we believe that some of our managers will be able to pick through various tranches of structured credit opportunities to find opportunities where the risk reward is really strong, where there's significant collateral cushions in these structures relative to expected defaults that the structure may have, where they may earn a really, really solid, attractive rate of return on a yield to maturity basis on a go forward. But we also believe that the price action for structured credit on a go forward basis may be volatile. It's an asset class that may have mark to market volatility, yet if you hold it to maturity, this opportunity may enhance forward expected returns. High yield bonds. It's an area where this particular market is down 14+% this year. We believe that, on a go-forward basis, our managers may be rotating out of bank loans into high yield securities, but this particular piece we don't have a lot of exposure to this. So this particular piece may be an area where we may lag as high yield may retrace and bounce back depending upon forward opportunities. Next slide. This slide shows the history of the last, since 2001, how spreads are elevated in the current market opportunity. We believe that this is where our managers will take advantage of opportunities as they allocate to higher spread opportunities relative to government OAS. This slide typically we show the yield to maturities. We usually show the same slide, but as a spread. Well, this year we wanted to show like the yield to maturity. It's pretty attractive as of 9/30, and even today, the yield to maturity across high yield is pretty attractive. We're approaching and surpassing double-digit yield to maturities, and so it's so attractive to the point where I personally want to stop thinking about things in a relative basis. At what point do you say earning a 10% yield to maturity adjusted for credit losses is attractive, independent of what happens tomorrow, independent of where rates go, independent of what happens to inflation? When do you pause and say the current opportunity is attractive enough to increase your exposure to this asset class? And that's what we've been working with the treasurer to put things in place to take advantage of the current yield to maturity opportunity that exists. Next slide. A year ago, we came to you talking to you about how tight spreads were. Today, we're talking to you about how wide spreads are. This particular slide that John put together takes daily observations going back to 2010, January 2010, and puts them into percentiles over that historical period. A year ago, we were at pretty much the last 10-year, 12-year tights, and today we're at the wides of that particular observation across multiple opportunity sets, from high yield to lower rated high yield to medium rated high yield securities, and even the 10-year treasury. And this is the opportunity set or the pond that we hope to fish in as we take advantage and allocate. We'd like to take advantage of the expected 9.5% yield to maturities that exist across the broad high yield index. Next slide. Opportunities don't come for free. You know, the headwinds that we're facing include economic environment, volatility, rising interest rate environment, and the repricing of risk across all asset classes. Additionally, European investors, things that we just alluded to in the previous call or previous conversation, they're all impacting the current market environment. Supply chain disruptions, hung deals on bank balance sheets, lower issuance across most credit asset classes. These are the headwinds that are currently we're facing. But these headwinds also create pretty good tailwinds. The tailwinds or the positives of the environment is that our managers are able to originate loans with higher coupons associated with it. They're able to originate loans with improved financial covenants, with more collateral. They're actually able to move up the capital structure without a material trade-off in return expectations. Additionally, even in structured credit, managers are able to take place or invest in higher rated tranches in these capital structures, yet have significant amount of enhancements. And if these structures were to experience defaults, the tranches that they're participating in would not experience an impairment unless there were a draconian market environment that occurred. Additionally, we have a strong manager lineup that can pivot as market conditions change. One thing that we take pride in is that we have about 70% of our assets invested in what we call separately managed accounts or funds of ones. In these separately managed accounts, it allows us to talk to the manager, see what opportunities are currently being originated. And as those opportunities are pretty attractive, we can talk to them and ask them to lean in or kind of sit on the sideline around different things. And so as these environments continue to change and deteriorate, we believe that the separately managed account focus that we have will be the linchpin for taking advantage of opportunities that we can. Next slide. Again, our priorities for the upcoming year will be to take advantage of the elevated spread and yield environment with best-in-class managers. Again, we want to be very conservative. I think that's been a great thing that we've done in the past, and history has been kind to us in this area, and so we want to keep doing that. We want to stay senior in most strategies. We want to take advantage of the floating rate environment that we have where rates may continue to rise. We also want to continue to focus on SMAs and special co-investment opportunities that exist with our best-in-class managers. And lastly, we plan to continue our dislocation mandates and take advantage of those across the portfolio. That's pretty much it.
All right. Any questions from the phone?
Yes, sir.
Thank you.
Thank you, Rob.
Very much. I want to talk about the ad we've put in the paper. We can? All right. Another part of our responsibility involves managing what we call our inflation-sensitive portfolio. And within the inflation-sensitive portfolio, we manage approximately $900 million of timber assets across the United States. These assets are Northwest and all the way through the Southeast. And we have one particular holding out in Arkansas that is pretty interesting and appealing to a potential mega site. We feel that it is the mega site. It's called a mega site. Yes, sir. We feel that it's pretty interesting for those that may be interested in economic development within the state of Arkansas.
We think that this particular asset just needs a little loving as well. But this particular asset, we've been able to showcase and harvest and take advantage of some of the current yield opportunities associated with it. But with our team coming together, thinking about the best ways to monetize some of these timber assets, we just marketed one of these assets in the Arkansas Business and Arkansas Gazette. We have a full page ad in that particular those publications. And so, we think that spending a little more time, not just on these assets in Arkansas, but our assets across the portfolio, we can increase the yield and things associated with that. While we're on these particular assets, the timber portfolio has generated north of $120 million of cash distributions since our team took over managing these assets, and that's been great. As everyone knows, that lumber futures are all over the place. Lumber futures in the middle of the pandemic went through the roof at per million board feet, and then it's a significant amount of volatility. And as owners of timberland, we sometimes scratch our heads and wonder, when will the price action for the timber that we actually sell to the mills, when will that actually change and go through, and where we receive increased coupon? And it takes a little while to flow through, but as we dig deeper and visited some mills and actually talk to the mills and things of that nature, we're actually seeing prices increase across the cash flows that we're receiving from mills, and that's been very positive for us the last several years. And pretty excited about what that particular portfolio holds for us in the future. I think the past, that particular timber portfolio has not been a shining light in the portfolio, but with inflation being what it is and what it may represent in the future, I think there's some positives. I'll stop there.
How large is the portfolio in Arkansas that you're marketing, or the parcel?
Yeah, the parcel that we're marketing,
2,038 acres.
Yep, and we're marketing it at approximately 10,000 acres.
$20 billion, 10,000 acres.
Yeah.
We own a lot of acreage beyond that mega site.
Mm-hmm.
So yesterday, the treasurer of Arkansas, who I've been trying to negotiate with to buy this, because why would they want us to have control of their economic development destiny?
Right.
Didn't make much sense to me. He got elected controller last night. Sarah Huckabee, who I have a relationship with, got elected governor last night, and then a new treasurer got elected. So, I mean, $20 million is not nothing. I just think that when this is their mega site, this 13 miles outside of Little Rock, that they'd want to have control of their own economic development
Sure.
destiny, not let us have control of their economic development destiny. So I'm trying to accommodate them and give them an opportunity to buy this. So, thank you. But, not a shining light in our portfolio was an overstatement. It's cost us 200 basis points on the whole fundedness of the plan for the last 16 years.
Yeah, I assume when Ron used the word interesting, it was interesting in a bad way, not interesting in a good way.
So, yeah, I can't imagine, well, there's probably been no time in history where you could have bought a portfolio like that at the worst time. So,
I still stand by, we need to sell firewood in the parking lot out here.
we don't have to go to yoga class if you'll run the splitter, or what are you going to do?
I'll do whatever you tell me to do, Mr. Treasurer.
All right. All right. I think Stanley would have a heart attack if we did that. All right. We're now, members, we're going to go to our public comment section, and then we'll go to the IAC, go around the horn. Thank you, folks. We have two folks signed up for public comment. Ben, you want to go over the ground rules?
Yes, so 3 minutes for the time frame for a public comment. And we've, as the treasurer said, we have 2 signed up. Mr. Justin Flores.
Yes, good morning, everybody. Can everybody hear me okay?
Yes, sir.
All right. My name is Justin Flores. I'm here on behalf of the Private Equity Stakeholder Project, a nonprofit that seeks to address the impacts of private equity and private fund managers on people and communities. I'm also a fellow resident of North Carolina for over 20 years. I was hoping to be with you all in person today, but like many of us, got a sick kid at home, so figured I'd spare you that. I'm here to talk today, call attention to the system's investment in Landmark Partners. And I'd like to ask for the opportunity to discuss this investment with the treasurer or his staff. As many of you know, North Carolina has committed more than $3 billion to Landmark Partners in the last decade, and Landmark is a major investor in Progress Residential, the largest single-family residential landlord in the United States. Progress owns over 85,000 homes in the U.S., it's over 7,000 here in North Carolina, and corporate landlords like Progress have been squeezing out would-be home buyers and burden renters with rising rental costs and prolonged maintenance issues, which has huge consequences for North Carolinians, including retirees and their families. Recently, Progress faced repeated allegations of deceptive business practices, hasty evictions, and property neglect. In February, their subsidiary was sued by the Minnesota Attorney General for engaging in behavior that was, quote, deceptive, fraudulent, and violating Minnesota law. In May, an investigation by the Charlotte Observer covered how Progress Residential and other corporate landlords, with some disturbing facts and some horror stories from tenants. And in July, a House subcommittee found that Progress and its subsidiaries engaged in abusive tactics to remove tenants from their home. And so as landlord's biggest public pension donor, we believe the system can and should play a role in supporting North Carolina renters to make sure these issues are remedied quickly at a time when housing is a major financial burden for urban and rural North Carolinians alike. We look forward to discussing ways that the retirement system and Treasurer Falwell can help devise a path forward that, of course, protects the pension system and also supports North Carolina retirees and families struggling in a difficult housing market. So I do have an open email chain, and I will be following up and look forward to speaking with folks on the committee a little bit more about this issue. Thank you for your time.
Thank you, Justin, for calling in. Our next caller is Jessica Moreno.
Hi, can you hear me?
Yes, ma'am.
Awesome. Good morning. My name is Jessica Maria Moreno. I'm an organizer with Action NC. Our mission is to win greater racial, gender, economic justice through popular education, grassroots organizing, mobilizing, and increased voter participation. Action NC is an affiliate of the Center for Popular Democracy, a national network of grassroots organizations. We're leaders of Renters Rising, a national association of renters who live in corporate-owned properties. Renters Rising is organizing to transform the unequal housing system in our country so everyone has a home to thrive. I'm speaking today as a leader in the movement to end corporate control of housing. In Mecklenburg County, Charlotte, North Carolina, corporate landlords or institutional investors own a quarter of all rental homes. We've been organizing and talking to tenants that live in these properties, and we see the same trend: increased eviction rates, reduced conditions and services, and increased rents. We, on behalf of tenants of North Carolina and tenants living in corporate landlord properties across the country, are calling on your board members to halt new investment with Landmark Partners due to Landmark's history of unfair eviction practices, rent hikes, and poor services. North Carolina has committed more than $3 billion to Landmark Partners. It's time for you to use your substantial pull with Landmark to call an end to these practices. We testified in May about the Charlotte Observer report that found that the business model of Landmark Partners backed Progress Residential and other institutional investors, it's finely tuned to squeeze profits out of their home, often to the detriment of renters, neighbors, and other would-be home buyers. Since then, there's been an increased public attention on the issue of corporate landlord control. with an eye-opening report of Congress about bad practices and extensive news articles. I speak with Progress tenants across North Carolina, and every year the rent is going up. It's hard to reach their management company, and the routine maintenance and minor repairs are on the tenant. It's their responsibility. So tenants feel stuck in a market where there are not enough options for affordable housing. Lease renewals go up 150 to 300 over the previous month's rent. If tenants stay on month-to-month leases, the rent goes up $200 to $500. Corporate landlords are buying up all the houses, so rather than becoming homeowners, tenants are forced to continue to rent because of the lack of options. Housing is political. There's no way that we can stay out of that. And you're literally funding displacement and homelessness. Your loyalty is to your members, but with great power comes great responsibility. And the negative impacts these companies have on the real estate industry will have long and short-term effects on everyone, including your members. We're asking that you stop investing money in Landmark Partners and instead investigate the negative impacts that the company is having on the people of North Carolina. Hold them accountable to treating renters like humans. I'm organizing for everyone to have a home to thrive. Thank you for your opportunity to share my experiences, and I look forward to seeing what actions you all take in the near future.
Okay, thank you for joining us. We'll now go to our, hereby deem our public comment section closed. And I'll go around to the horn to see if any IEC members have any questions or comments, starting on the phone.
Hey, this is John Andarella. Thank you all again for your presentation today. You know, another thing that's been in the news lately is some of the bigger asset managers and how they are voting and whether their voting is in line with the pension plan or whoever they're managing the money for. So I was just curious if you've looked into that and what, if anything, may be happening about that.
Thank you, John. At my direction, our legal team has been spending a lot of time over the last 2 weeks negotiating with BlackRock regarding the use of a new system where we can adhere to our fiduciary responsibilities of getting quality and value for our participants in our pension plan, but remove some of the woke ESG strategies that BlackRock is trying to implement by voting our proxies. We're in the 9th inning of doing that, and so I just want to give you comfort in knowing that that's in the oven, almost in the oven. And then you'll be hearing more from me next week about that issue in general.
Thank you.
It's Lance Moore. I just wanted to appreciate staff, Chris, Jeff, and Ron for very insightful reports this morning. Continue to be comfort with their level of professionalism and quite frankly, their competency. Keeping us in a great place amongst our peers in such volatile markets. So good job, guys.
Thank you.
Thank you, Lance. Anybody else? Mike, any closing comments? Okay. Great.
Just echo and thank the staff for all they do. I know a lot of time goes into these presentations, and that's not lost on any of the committee members how much effort you put into it. Thank you.
Thank you very much. Greg is going to remain on the investment advisory committee as long as I can talk him into remaining on it. So we appreciate your willingness to serve in that regard. With that, I wanted to thank the team for all they've done. We have been managing during the most volatile period in the modern era. It's hard to believe it's been 6 years since I said that, you know, the future of North Carolina for the next 25 years is going to be based on what happens at the treasurer's office, no matter who the treasurer is going to be. And as you can see, that's never been truer. Whether it's preserving and strengthening, but figuring out how to actuarially sustain this pension plan, our health plan, the challenges we're facing in our local governments. These are all things that are really happening, and we have to deal with these as they do happen. So with that, in honor of our veterans, those that are in present, and those that our participants and those in our state, would entertain a motion to adjourn.
So moved.
Second.
Second, John Anarella.
Thank you, John. Any further discussion? Hearing none, the clerk will call the roll.
Mr. Brewer,
Aye.
Mr. Mevin, Treasurer Fall.
Aye. Okay, we're adjourned. Thank you all very much. Thank you, staff. Thank you, Matt.